Here's Ken Calhoun live with the latest trading strategies for today's markets.
Hi traders, in this episode of Trading Television, you'll see another one of my all-time favorite strategies updated for the current markets. I think you'll be excited once you see how it works.
Hello active traders, this is Ken Calhoun, president of Day Trading University, with another episode of Trading Television for you here on Friday, January 30th, 2009. In this video, we're going to be sharing exactly how to use our ETFs, 5 of them, as lead indicators using not only our 2-day 1-minute chart, but also our intraday tick-by-tick chart and time in sales to help identify whether or not it's a good time to get into positions that look to be oversold. Now, I don't know about you, but it's frustrating to me to buy what looks to be a market bottom. For example, something that may be sold off sharply, and I think it may be a bottom starting to bounce, only to see it continue to go against me after I'm in the position. How many of you have done that? You see a stock sell off, it looks like it's bouncing, you buy it, then it continues to move another half point against you. Well, this technique that I'm about to reveal and explain to you is what I use to help identify whether or not we are in fact likely to see a market turn. And it relies upon the careful professional use of these 5 ETFs. The ones that are similar to the market, are in trend with the market, are the spiders and the Qs. You should be familiar with those. What you're going to be learning in the video is how to combine that with other technical indicators on the 1-day chart to very quickly and easily see whether or not there is in fact a likely market turn or a likely market bottom that's worth buying in the stocks that have sold off. So again, this is not how to trade the ETFs themselves, though you could certainly use what I'm about to teach you to do that. This is more how to identify whether or not in fact we do have oversold or overbought in some of the stocks. For example, today dry ships, a great intraday and swing trading stock, sold off quite a bit today, down almost 18% on the day. Is it likely to bounce or not? Well, what we want to look at is our ETFs. So the long ETFs are spiders and the Qs. The short ETFs are SDS, and again, they will look as a exact mirror image or inverse to what the broad market and the long ETFs looks like. These are short ETFs, so when the market sells off, these go up. And looking for pivots in those, especially to the downside, tells you that a market long or market bounce may be in the making. The key is not getting faked out or having a false breakout or breakdown in the patterns, and that's why it's so critical to add clarity using some of the candle patterns and other techniques that are available to you in addition to the tick chart. It shows you exactly 1 minute at a time worth of candle data, what's happening, plus using time and sales to identify momentum breaks and whether or not that move is likely to continue. So that's what we're going to be covering in this very important video, and certainly a lot to learn about. The other ETFs, the short ETFs in addition to SDS, are the DXD, that's the Dow Ultra Short, and the QID, which is the Ultra Short Qs. So used together, the key is using this as a system. The QID, the SDS, and the DXD are the short ETFs. We compare those with what's going on in the spiders and the Qs, which are our long ETFs, in conjunction with our NAS composite and both of our trends, the listed trend from the NYSE market and our NASDAQ trend, to give us a very quick picture as to whether or not an entry is worth taking. For example, in a stock, if you're following these stocks that are, for example, this is my current watch list portfolio, going through and seeing which of these are most sold off and look like they would be of interest for a possible bounce if the market starts to come back on volume, and what kind of plays there might be available for us to make wins in. Personally, I like dry ships because that one seems to have the most volatility if it's able to break previous resistance, and we have supporting signals from our market ETFs, which obviously we don't right now. For example, see how this is a false breakout? Let me pull up the today. See how this was previous resistance? It sold off, recovered a bit, sold off, recovered, sold off, recovered a bit more, sold off, down, took out new lows down here. You can see almost a hammer here in candle, and it did recover off that near hammer pattern, but then it sold back down to retest support. Now would be the time at which I'd be looking for a possible bounce on volume, and confirmation to add to a winning position would be, for example, if in a better entry overall would be if the spiders were to take out new highs over the 84. Then, and only then, would I be looking for a possible entry long in dry ship, say over 7.3 or 7.5. So that's what this video is going to share with you, exactly how to do that and what strategies you might want to start adopting to help put a filter on your trades to be more precise and more accurate, using the power of what's going on in the ETFs in addition to the composite and the trend to help you identify potential trade setups for bounce plays as they move in the current markets. Okay, traders, step number one, or the first thing you want to do in looking at the ETFs as lead indicators for in-market trading. Again, this is not using the ETF pre-market strategy. This is once the market has opened and is moving. The first thing you want to do is to take a quick look at what the previous day's range is. As step number one, previous day's range in the NAS composite and current day's range relative to that, and whether or not we are inside or outside previous day's range. The best setup occurs in days like what we have right now today, where the NASDAQ composite is at or near the previous day's range and it's an out day. This means that we're more likely rather than less likely to see a pivot or a bounce come into the market later in the session. Now, it may not occur until the closing hour or even half hour, but once it's already moved its current range, which you can see is roughly about what, 1505 to 1537, about 30 points, 32 points. How far has it sold down? Again, you can usually just eyeball this and see, does it look like it's about the same width, from here to there compared to, this is previous day to current day, 1525 to 1490. Yes, it is. So we have moved roughly the same. You can also, in addition to the NAS composite, pull up your Dow and your S&P. One thing to be aware of, or one kind of a red flag, is that if compared to the NAS composite, you can see the range of yesterday to today, the Dow has not moved, for example, the same range as it did yesterday. See the range in yesterday? It's larger than it is today. So that means there still may be some selling left before we find or retest previous day's range. And that's a key lead indicator. Again, we start by looking at the major indices, then we drill down into the ETFs, and then we look at our sectors and then stocks. And it's really important that you understand how to combine all that with momentum indicators like what's going on in time and sales. And again, keeping these tapes open of market action is a professional technique that I highly encourage you to test and start experimenting with. S&P, the same thing. S&P range is close but not the same as it has been in the previous day, so we are not as likely to see a bounce yet, or at least a retest yet, until those markets have moved similarly to what they had in the previous day. Now, our NASDAQ is kind of leading the way down here, so tech stocks taking more of a beating than our Dow component stocks and some of the others in the indices to follow, right? So that's just one more data point that goes into the back of your head to file away. Now, when we pull up our spiders, the SPY, you can see it too has not moved the same range as previous day. So that's the second technique. First is look at what's going on in the broad market indicators, or the broad market indices, and see if in fact they have moved near the same or more than or less than previous day's high-low range. It's best to use this strategy if what? If the market indices are at or beyond previous day's ranges, because we're looking for a pivot. We're looking for short covering, for example, in this market. It may not occur to the last hour of the trading session, and we'll revisit today's market as we do that. Now, we're going to use that to look for entries in stocks like, for example, dry ships that is sold down sharply. You pull up your lead into your indices that show which which stocks have sold off sharply, maybe starting to bounce. You can see others that are worth a look to add to your watch list, and that's another strategy, but that's to cover in another time. But that's, again, you're looking at your NASDAQ and listed gain and loss percent stocks. And if you're looking, for example, in this one, DDUP, what is that? Data domain. What we're looking for is possible bounce plays. Say you missed this first bounce play, and that's fine. I always get new stocks to pull up, which is part of the wonderful thing about trading. We have so much variety to work with. Well, now we see what the technicals are. 13 is support, 15 is resistance. Market selling down. May look for another bounce if it starts to get back over the 14, or if it sells down to under 13, look for a bounce if it gets over 13.3, 13.5, right? Look for a short if the market continues to plummet and we get under, say, 12.5. But I'm looking in this particular video for things like bounce plays, and you can see dry ships. Juniper Networks also down a full point here, over a point since its gap down. And as usual, we like to see gap down continuations, but we do want to see short covering. Let's say you don't want to short, or you missed a initial bounce up looking for the next bounce. That's where this play comes into use and is particularly useful to help identify whether or not, so in those stocks, whether or not there is likely to be a bounce. And this is what I look at to help me identify that. I look at, for example, the spiders. Are we seeing a bounce here? Do we see at least a couple of candles? You may want to use multiple time frames on candle patterns to see if, in fact, we have a hammer, right? Is there a hammer at a new low following a downtrend that signifies a potential reversal? Now, again, and as Steve would say too, single hammer pattern or single candle patterns do not a system make. That's why we need to integrate this with techniques like time and sales and how to work together with our indices to identify whether or not a trade setup is actually likely to occur. So anyway, this is our spiders. The other one we look at, kind of the flashlight on the interior of the market, is the Qs. And then, of course, we look at our trend. Is that starting to drop? No, not our NASDAQ trend, so it tells me to be leery of, if the trend was starting to drop here, say it moved up earlier as the market sold off. Remember, the trend is an inverse indicator. If the NASDAQ trend starts to trend down here sharply, at least, I see some move down in the trend. That means we're going to see an uptick in the market or new buyers. I don't see that, so I'm kind of skeptical about any long action in the market. That tip alone is very, very important, very valuable to know. And we also pull up our listed trend, also still up over the 1, up near 1.5, so still in short, barely, but short country up here. So unless this starts to move down sharply to approach and preferably sink under the 1, I don't see a real strong reason to be out there buying stocks. So you combine that, or you look at that in addition to the spiders and the Qs to help you gauge whether or not to trade. Now, let's say you see a stock that looks like it's particularly oversold and is about to bounce. Here's one. Say Las Vegas Sands. It's not taking out the 5.25, 5.3 yet, so I wouldn't touch it unless it does. In fact, it's selling right here, but it's down almost 10% on the day, from 5.7 down to 5.1, and looking for moves, whether or not it bounces in our current session. Let me pull up a swing trading chart just so you can see yet another piece of the puzzle to look at that's worth looking is looking at, say, the 25-day chart and see if we're at or near previous support. In this case, we are. So I'm moderately bullish to see I maybe buy this if it bounces over, say, 5.3 or so. But to do so, I'd want to see in my ETFs, I'd prefer to see, for example, in the spiders, let's take a look now at, this is a new, or the next strategy, look at the 1-minute tick chart. This is tick by tick what goes on in the spiders from the pre-market all the way to the market open, where it's sold off with the broad market, got some short covering a bit, but sold off again to take out new lows. This is the spiders. This is a microscope on the spiders. The 1-minute chart and the better microscope even is time and sales. Where here would tell you to buy stocks, so that buyers are coming back in and you should consider being a buyer as well. Where would that occur in this chart? Well, I would say not unless it gets over, say, 83.4 or so. That's a likely resistance level that other traders are looking at. Now, if you see something sharp, a stock that's sharply dropped off and starting to bounce on high volume, then yeah, you might anticipate and get in if it gets over something earlier like 83.3 or even 83.35 or so. But big picture, 83.4 is kind of the long signal area in this. And as you follow the tape, the time and sales of the ETFs, you'll start to be able to identify in real time what kind of buy and sell pressure you have, what kind of momentum action there is, what the sizes are being traded in this ETF, and what kind of net market moves we're likely to see coming up in the minutes ahead. So really good momentum indicator to help you identify what's going on. Now you pull up the spiders and the Qs. Are you with me so far? And yes, trading does take a lot of professional discipline and focus. That's why everybody doesn't do it. If it was easy, you'd have people using software black box programs and magic arrows and actually trading and actually succeeding. They don't. Those who do well, we identify exact specific signals, and so it takes some work. Anyway, and that's as it should be. Anyway, looking at our Qs now, again, it should match up with or be very similar in terms of the visual pattern on the chart to what you see in the spiders, and it is, with some minor variations. What we're looking for here is what? Say recovery over what? 29.2. That's the previous support level in the Q. So I wouldn't be buying, or at least I would only be buying light shares and not looking for an aggressive long entry unless our Qs recover, say, 29.25 or so, 29.22. And you can see when that's about to occur by following the tape. You look for the imbalance of the sizes, you look for the net aggregate size being traded, the speed of the tape, and most importantly, the price action. How far does it go before it takes out each new 10 cents worth of price action? So those are our long ETFs, which will match the direction currently down of our broad market. To look at the other key indicator to look at, the next technique is look at our short ETFs, because they will give you a very clear indication of whether or not sellers are done and short coverings coming back or new buyers are coming back. In this case, we do see that, right? Let's take a look at time and sales for our SDS. Do you see how it's starting to test visually the 80.5? What I'd want to see is this plummet down under. And again, I'm recording this live. I have no idea what's going to happen next, so this is how I trade. Looking to see if it gets under 80.5. And again, all this is precedent. So you're probably spending, as I did when I was first learning how to trade, spending far too much time just on the stock charts. The main thing you need to do is identify whether or not, and again, the more experience you get and the more practice you get, the faster all this becomes. I do this on autopilot. I'm click, 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 bang, and I've got a profile of whether or not I put on that trade in dry ships, within 20 seconds, 30 seconds on the outside to do a quick overview looking through the tape and the charts to see whether or not I should be a buyer or a seller in this market. So anyways, with our SDS, our short, one of our 3 short ETFs, it's the ultra short S&P, you can see we have in fact taken out 80.5 in the tape. So what will you expect to see in the spiders, in SPY? A move up, right? A corresponding move up, which in fact we do. So no surprise there, but is it strong enough? Well, for the answer to that, you need to have identified your predetermined support. We're taking out 80.5, staying underneath it for at least a minute or so. I have not done so yet. SDS. DXD is the other of, the second of 3. The other, this is the ultra short Dow, and you can see it's starting to move. Where would support be on it? Well, 62. So I'd want to see both the DXD get under 62 and the SDS get under and hold under 80.5 to tell me that buyers may be coming back in. And the third data point is our third short ETF, the QID, which is the Q's ultra short. And where's the support on that? 57.5. So again, I'd want to see this one get under and hold under 57.5, just as with the SDS under the 80.5 to hold that. Looks like we are starting to get a potential pivot, right? And then flip back to the long ETFs, the spiders, to see if we're getting a bounce. Looks like we are. And our Qs. And you start to see the precision, the accuracy with which you need to be looking at these charts. It's very important. Again, it all starts with just a quick look at the 2-day chart, which tells me ranges, support, resistance, open, high, low, close, directional move, volume, and the rest of it. This is a good way to see, for example, volume in the market is to look at the surrogate volume in the associated ETFs, and it's a really good strategy. See, for example, spiders look like they're trying to bounce here. Now, last time what happened when it looked like they're trying to bounce? Well, they did a bit, and that's a next strategy. The next strategy is identify how far, when it has, say, bounced in previous bounce attempts, has it moved before selling off, if it does. And in this case, you can see this range, if I were to mark out from here to up here, that's the range which I use to say a false breakout or bounce trigger. So, you could jump the gun and get in small shares down here, but I would expect to see some overhead resistance where? I'd say about 83.25, 83.3 in the tape. So, using that as resistance, I'm most likely to now go look for a long in, say something like dry ships, which I would expect to bounce sometime soon in here, or LVS, or one of the other sold off stocks anytime, right? This is a good, let's take a look at the tape and dry ships. Starting to bounce a bit. Let me put that under the advanced chart so we get a closer look. Let's pull that up. That's the tape and chart in dry ships. And again, recording this live, I always like to pit myself against the markets and be able to nail my calls for you. Anyways, 6.7, would we be a buyer here yet? Nah, I'd kind of be a skeptic. I'd say 6.82, show me kind of a show me entry, make it break the dime, make it get over 6.82. And again, we want to flip back to our ETFs and see if they're holding or not at the time of entry and throughout the trade. And that's another really critical indicator is, are the ETFs holding in your favor during the trade or not? And if they start to go against you, for example, spiders, they moved up a bit, but they're not taking out that 83.3 by any stretch of the imagination. Do you see how you see a red candle here forming even, and it's kind of chopping around here near 83.2. We are not yet over, say, an 83.3 level. So if I had just bought dry ships on a bounce, which I wouldn't have yet, but if I had, I would look to stop out if the spiders, say, for example, started to lose support. Drop dead would be if they got under, say, 82.9, the previous low. But even if it starts to weaken here, again, for scalping, if it gets under 83.5, say 83.12, I would be exiting a long position because the spiders aren't in support of that trade. See how that works? So one of the keys is then be a skeptic in your entries and make it break through. For example, in dry ships, I'm saying 6.8, right? 6.82 or so would be the earliest. Because again, if I'm right, it's got plenty of upside, at least to 7.25, 7.4 for half the position, and likely chop around there and may run into the close. Right now, it's just 11:30 Eastern. We'll see where that goes, but it's a really good precision trading strategy to make the stock come to you and only play ball if it does what you want it to, right? What you make it come to you and trade it on your terms, not its terms. So for me, I'm saying, I'd only buy if it gets over 6.82 and the spiders and the Qs are supportive long and the short ETFs are telling me short, right? So there's the Qs starting to bounce. Here's the spiders starting to bounce. Our short ETF starting to drop, which is good. That's bullish. SDS, DXD, and QID. And again, use what you've learned from me about tape reading in terms of the velocity of the tape, the ability for that instrument to move through sequential dimes of price action, the size is imbalanced, the average share size, how fast the tape moves, is it picking up volume and velocity, and so forth, to help identify whether or not there's likely a trade in front of you. And sure enough, we see that, I would not want to be long this instrument here, the QID, because it's moved to the previous day's range and is likely to pivot or at least chop around here a bit. So if I had been long this, I would be exiting out and taking the win to the bank. And same thing if I was, say, short the spiders, I wouldn't want to be short here, right? This is a place I'd want to be covering out because it looks like it's about to bounce. So that tells me now when I go look at my stocks, what looks like it's bouncing, in other words. And where is the specific entry trigger above which I would make a move before I consider a potential purchase of that instrument. And by the way, for example, this one in Win looks good, but only if it breaks over, say, 31, right? Now, and I don't like the fact that that would put it up near half of its range, right? Usually that will chop around near 50%, but since we're late to a bounce party, we didn't get it at 29.7 or just over the 30. It's already up to 30.56. Earliest entry trigger wouldn't be until it breaks the 31. And if one wanted to go short, you could short it here and trail a cover stop at, looking at the tape here, let me bring that into view, trail a cover stop at, say, 30.8. Again, this is for day trading. So this is a good strategy to use too. Where would the short be? Where would the long continuation be? Where would your exit target be? And how would you look at it for an entry? Here's United, for example, selling off sharply. Something in progress for a drop. How do we deploy that now into our decision-making process for potential bounces when combining that with the ETFs? Well, what's going on with the spiders? Well, see, as I said, it did not break that 83.3, right? It got to about 83.2 and starting to drop. So we do not want to buy stocks here because the ETF is against it. The ETF has not broken our resistance level, so we do not want to go out there and be a buyer of stocks unless we see an overriding technical like high volume or something else that tells us it would be a good entry. So here's 9.6. Where would you buy it? Possible scalp over 9.72 or so, or short under 9.5 would be more likely, right? A better play, but that would be the brackets about which the current trading range indicates a trade setup in a nice volatile chart like this one. Here's another one, LCC. That's U.S. Air. And I guess that whole sector looks like it's been selling off. Possible bounce if it clears 5.8, but we wouldn't touch it between 5.6 and 5.8. And again, looking at our NAS composite, trying to find some support here at the 1480, but hasn't proven itself to me yet. And certainly our trends starting to trend down a bit here, but not down in long territory by any stretch. So we don't really anticipate a strong move there. So the key is look at the ETFs to give us a clear indication. SDS is dropping, pivoting, which is good for longs, right? So we're going to look for a potential long. However, here's another strategy note from this play. Look for it to move down only about as far as it did the last time before you start to get suspicious and exit out of at least partial position. So, for example, the SDS, our ultra-short S&P 500, moved down from 80.2 to 79.2, so a full point. So 1 point range, has a 1 point range. And on the upside, move here, 1 point. So when it moves in a single, bound over a leap a tall building in a single move, it moves 1 point. Okay, so what that tells me is from 80.7, we're likely to see it move down to where? About right there, 79.7, 1 point before potentially consolidating or pivoting. Now, it may continue to drop, but this is a good place to exit, say, half of any open long, and or trail a stop maximum if you are already short something looking to cover. And again, this is the short ETF, so it goes in inverse direction to the market. SDS, QID, again, looks like it's dropping. Would you want to be, another question to ask yourself is, would you want to be long this, this position if, say you'd bought down here and it's moved in your favor? And the answer would be no, right? You'd want to exit this, take it to the bank, not re-enter unless it takes out new highs. So that tells you this would probably be a good place to start looking for bounce longs and oversold stocks, because our spiders definitely look like they're bouncing here. It is, 11:42 Eastern, so right before lunch. We've seen these lunchtime pivots as one pattern in recent market sessions. It looks like they're doing that a bit here. I'm still a bit skeptical, but it is a good place to start looking at for either covering out shorts and or looking for long bounce plays. And this is a good example. Dry ships, again, I wouldn't touch it unless it gets over 6.8, because it's been under sell pressure the whole day, right, from 8.4. But this might be a good pivot entry if it breaks resistance. But I wouldn't touch it here because it could still continue to chop and drop. You don't want to buy this. I've done this. I'm sure you've done this too. It looks like a bounce, so you buy at the first sign of a bounce, and then it goes against you and continues to drop, and you take a stop on it or take a loss if you hold it for a swing trade or what have you. And we don't want to do that. What we want to do is make incremental, consistent wins. And so to do that, we want to make sure that the odds are in our favor. From a volatility standpoint, it is. It has moved to the edge of its previous day's trading range in terms of the number of points. 6.5 to 8.7 is out 2.2 points. That exceeds its previous day's range around 8.2 to 9.5, about 1.3. So it's well in excess sell-off of its previous day's move. So this is a likely good place to buy dry ships if it clears the 6.8. And again, making this call live. Now, let's say because of the ETFs, and even if we pull up our NAS composite in a line chart format, and see an uptrending bottoms, right? Uptrending bottoms there. So, but again, we saw that here and it still sold off. So I'm not, extremely bullish here because our trends are still relatively short signal trends. But if you were to jump the gun and say, okay, I think we're at a bottom here in dry ships, I'm going to go ahead and buy it at 665 or so if it breaks that. Where would your stop be? Well, it would have to be under, say, 6.45, right under 6.5, right? That would be the maximum stop value. So you'd only give it 15 cents, maybe 20 cents at the most. On a $6 stock, 20 cents max on a day trade for the initial stop. Anyway, so if you're to buy here, stop would be down here. And again, you combine that call, people wonder, how am I able to make such good calls? Well, it's because I take a very keen look at the specific signals that the market internals are yielding to me, and looking for pivots in our ETFs as they reach previous day's ranges at likely times of the day. And in the current market, we've seen lunchtime reversals for whatever reason. That's when they work out of their positions, and then the other side comes in. Has been one of the key patterns in recent weeks. Likely not to be a pattern that's dominant, say, a year from now or 2 years from now, but for now, that seems to be one of the dominant patterns. We want to capitalize on that by identifying good entries once they occur. And now that we take a look, following up here a few minutes later with our dry ships, you can see that, in fact, that is moving nicely for us and has just poked its head over 6.8. The key now is following up in time and sales to trail a stop mentally, trail a stop on the position as it's moving, and get ready to exit at any first sign of trouble. But anyways, looks like we correctly identified the bottom in dry ships. And again, maximum stop out value would be, say, 6.45. I would use just under the 6.5, so we're using about a quarter point stop for this, because it may continue to drop on down or it may consolidate and shoot up. But the point is, trail the stop or use an initial stop under previous low, and use a combination of that with our ETFs. So to tell me whether or not I want to stay in this position, looking at the spiders, are they still going up? Yeah, so I'm fine. Qs still going up? Yes, and in fact, those look really good. It's a good upside move in the Q, so that tells me likely my entry call for dry ships is going to continue to be in good shape. And now we want to see our short ETFs continue to show a lot of red and drop, well, which they are. See how the SDS is starting to move down here at 79.8. Our QID likewise also dropping, and our DXD also. But the main one to look at is the SDS, because that's the S&P 500 short, and the SPY, which is our long spiders, and they will be opposite to each other, and together they paint a very clear picture, especially when you put them under the microscope here of the 1 minute advanced tick chart and our time and sales. Tell us what's going on here. So spiders up over that 83.3. Next resistance is what? 83.5, and so forth, as we see whether or not we're able to get some legs in this later day bounce move. Dry ships looks like it did bounce nicely, and if one had scalped off the bottom there, this would be a good place to exit half into, right under the 7, and see if we're able to continue to get legs and get some upside momentum in dry ships for the balance of our session based on what we're looking at in our ETFs. Another one I had pulled up among several others, Las Vegas Sands LVS, also looks like it has moved up nicely. So really good strategy for identifying bounce candidates, which we are seeing a lot of in this current market. FITB had been one that had sold off down from 8.5 down to 2.5. I correctly called a move up over the 3 in an earlier day's video. Now we're taking a look to see if some of these other more volatile issues are worth an entry, and you can see that dry ship certainly looks like it is. Another good thing about using the signal chart here is you can left click and drag anywhere on the chart, and that kind of zooms it in for you, so you can take a close look at that along with time and sales to see a very precise tick by tick, transaction by transaction flow of what's going on in that stock. Really good, powerful strategy to or setup to be able to see how to use these strategies. And that was a good call, right? From 6.8, catching, and we'll see how it continues to work as our market continues to move. Now, following up with dry ships just a bit later, you can see that certainly that was a winning call. Putting it under the microscope here, 6.8. The break point for entry, it's since moved all the way up to 7.3. Good place to scale out or exit at least half of any open long position. So I hope that this is demonstrated for you in live markets. Coming back here to revisit this, not only the validity but the usefulness of identifying pivots using our market ETFs as lead indicators. Let's take a look at our NASDAQ composite here for today. Downtrend has been broken, though it's likely to continue to chop around here just a bit, but that's a good play for trying to figure out when the market is going to pivot and when would be a good place to enter, or an opportune place to enter some of these positions based on what we're seeing in our ETFs. And again, the spiders and the Qs for our alongside the SDS, the DXD, and the QID on the short ETFs that we use to then identify entries in stocks like dry ships, which I nailed. I got the exact bottom call for y'all here as I recorded this. It looks like LVS, one of the earlier ones too, has also moved up fractionally here, but a bigger move certainly in dry ships. So that's a very powerful strategy. Again, to recap, the first thing we want to look at is the broad market indices, the NAS composite, your Dow, and your S&P, and then identify from that, using the associated ETFs, the spiders, and the Qs, where exactly are we most likely to see pivots based on moves that go outside of the ranges or pivot back into ranges once the ETF instruments have moved at or beyond previous day's high-low. And again, this is for once we're in market. Now for pre-market, to identify directional moves, this is once you're in the market, say after 9:45 or after 10 o'clock, and you're trying to figure out, say on a down day, when's a good time to be looking to potentially buy the market. And these are some of the signals and indicators that we use, at least that I use, to provide very good trading setup opportunities like I nailed for you in dry ships off the bottom here. And again, this would be a good place where I long bounce trading this as I called for you over that 6.8 and up over the 6.6. This would be a good place to exit because we're near previous consolidation with 7.4 as the immediate resistance. This would be a great place to take half or 2/3 of a position off the table. I would be, I would certainly take at least half of it. If I were, say, long 1,000 from the 6.8, I'd close out, say, 700 or 800 shares of it even up here in 2/3 or 3/4 of the position at the 7.2573. You could always re-enter long if it breaks over, say, 7.4 and again over 7.6. But for now, this would be, that was the trade. That was a good bounce play, and those are the type of entry signals that we can deploy into, in terms of specific stock entries once we know how to read our ETF pivots. And that's really what this is all about, is how to use your ETFs as lead indicators to tell you whether or not to exit open positions or initiate new counter trend positions as well. And again, use this all in context of and in addition to market internal indicators like the trend and the VIX. And the last bonus tip here too, the VIX is typically a good short type indicator. The more it goes up, the more the market sells. When the VIX, similarly to the SDS, QID, and DXD, when the VIX starts to pivot, that's usually an indication that your broad market is likely to see some upside move as well. So, and also it's a good time to cover any shorts. If you had been open short, when the VIX starts to flip back down into its range, when it starts to go red, that tells you that the market's usually getting buyers back in, so it's a good time to exit short positions. I use it primarily in this market to initiate new bounce long positions. When you start to see the VIX lose previous support, in addition to our short ETFs like the SDS, the DXD, and the QID, tells me it's a good time to look for potential bounce continuations for yet new plays or yet additional plays in what's going on in the current market, and look for additional moves as well. Anyways, that does it for this video. I hope this has been helpful. Again, just combine, add as an additional dimension to your trades, in addition to looking at the NAS composite and our Dow and our S&P, take a look at the associated ETFs, and most importantly, pull up the 1-minute chart and look for pivots that go beyond the previous depth of the pullbacks, for example, on the 1-minute chart, or for sharp moves that break an uptrend, for example, for long bounces. And if I could draw a trend line here on the upside, you could see it was broken to the downside here, continued up, broke down again. That tells us that we're getting buyers coming back, albeit incrementally, into the market. Again, this is the inverse move from our short ETF. So when this goes up, the market goes down. So when this starts to show a lot of red, it's time to look for potential buying in the market, just as we look for in-trend directional moves in our spiders and Qs. After the market sold off and these instruments have sold off, we start to look for bounces. The combination of the 5 gives us a bit more sensitive indicator that we can use, because you will see lead indicators or stronger signals that are outliers. For example, look at the SDS. You can see it is taking out lower lows, lower highs. It's definitely in an uptrend. But how does that SDS compare to the QID? Well, the QID, the depth of the pullback is deeper, so that confirms that we are likelier to see additional buying come in. And the DXD too. And again, look at if and when it gets under 61.5, that's a good place to look for buying oversold stocks or adding to positions if they break over new resistance. And you can see dry ships, that was a good call. It looks like it is in fact starting to drop, so that was the right place to exit after a decent move up in it for us. So those are some of the patterns and the sensitivity with which we like to look for entries. Also, again, looking at our VIX, if the VIX is in a nice strong downtrend like this, you don't want to do what? Initiate new short positions. You do want to either add to existing longs or start to scale out of existing longs if what? If this starts to go back up, because that means that the broad market's going to go down. And same thing with our exits using these two. If, for example, the SDS starts to take out new highs, say the SDS now started to get over 80, that would tell me that it would be a good time to consider exiting at least half of any open long positions, because it would have broken that immediate downtrend. So if it gets over the 80, that tells me that sellers have, again, because this is the ultra short, it's a short S&P ETF, that tells me that sellers would have come back into the market, and it's likely a good time to exit any open longs. But as long as it continues on down or drifts on down and stays under this trend line, I'm okay staying in my long positions. And again, confirm that with the spiders to the upside. As long as they hold above that trend line and continue to climb, it would be okay to stay long. Now, if the spiders lose, say, the 83.3, if it gets back where, remember the 83.3 on the upside was our buy signal. If it loses 83.3 on the downside, that's a good time to get out. You have to wait for it to take out new lows. I'm looking for, in this kind of a market where it's a primarily selling market and we look to play bounces, any signal, the first sign of trouble that takes out a support, a close support, is a good reason why an exit would be initiated. So 83.3, if it loses that 83.3, I'd look to get out of any open long positions. I'd be looking to get back in and add to longs or initiate new long positions if we take out new highs, however, over say 83.7 and again over 84. And again, look to sell everything into 85 as potential resistance, since that's near a previous high that we had encountered in the market. So anyways, that does it for this episode of Trading Television. I hope this has been useful to you. It's a good strategy, something that I use as a core to tell me broad market sentiment in a way that the indices alone can't do, because you have multiple indicators or multiple ETFs that you combine, as I've showed you, with the directional moves in the stocks to identify our long and short and entry and exit strategies for specific stocks, like that dry ships bounce I nailed for you, and others in our current markets. Well, that does it, and best wishes. This is Ken Calhoun, Day Trading University and Trading Television. I'll see you again in yet another episode. This is one more piece of the puzzle explained, and an important one. Best wishes for success in your trades.